Okay, now a great pleasure to introduce our speaker, Tim Palionis. All right, there you go. CFA CPA Managing Director is a member of BlackRock's U.S. Wealth Advisory business. In this role, Tim is focused on the overall design and implementation of U.S. Wealth Advisory, client education, experience, as well as learning and development for U.S. Wealth Advisory distribution. He has also held several roles at BlackRock before taking on this current role. He was a part of BlackRock's Portfolio Solutions team based here in Princeton, where he led the National Wealth Consulting team. This team conducts detailed client engagements around portfolio construction and risk management to assist with asset allocation, portfolio structure, and implementation decisions. He was also responsible for the representation of BlackRock's model portfolios and development of the BlackRock Portfolio Construction Academy. Tim.
All right. Thank you so much. It is with great pleasure to represent BlackRock here today. Truly see it as an honor. I love the what could you be doing differently this year. I've kind of got my own version of that list. A couple things I'm thinking about. Am I flexing my curiosity muscle enough? What have I delivered of new insight in a group meeting recently to my team? Asking people how they're feeling more often. It's a really powerful question. And just generally understanding that life is just this journey of constantly learning, right? It is never off, and that's what energizes me most in my career, in my role, and what I do every day for my clients. So, I'm excited to get into this conversation today. I'd love to make it a conversation. I'll have a few prepared remarks on the front end, but really this is just a very complicated market, right? So I can't cover all corners of it. You guys feel it every single day as business owners and operators. We see it as asset owners and investors. And so I'd just love to, hear what's on your mind so we can be better at BlackRock. I think it's important we listen to our clients more than anything else. So I had a quote in the advertisement for this session that said, "Risk is a feature of the markets, not a flaw. When risk is more fully understood, great things can happen to build long-term health and wealth." And I think that is a really important thing to understand, especially after the year we had in 2022. And as we think about investing, right, just like running a business or buying a home, which I did 2 years ago, it is an incredibly emotional thing, right? And while you can't fully eliminate those emotions, the idea is always to work towards gaining more control over what's happening and really the ideas and thoughts you have around them. And so if I were to say, like, what are most of our clients engaging us on right now, whether it's public servants, parents, large institutions, it's really a desire for two things with their money. It's getting more clarity around what's happening, meaning better understanding what's driving the underlying factors of the risk and return in their portfolios. I'll talk about that in a second. And then it's also giving them more context, right, about the range of possible outcomes. So looking forward, not predicting per se, but just giving them a sense of here's what might happen. And really what you're trying to do is, again, suppressing some of those emotions and limiting their surprises. So they want to have more clarity and context for us, and I think of it as sort of the confidence equation. If we can give them more clarity, if we can give them more context, again, not prescriptive, super tight insights, because it's really hard to do that right now, they get more confident and it maximizes better outcomes, right? That's what our job is every single day at BlackRock as an asset manager, is maximizing better outcomes for our clients. And so a bit of the story today is risk, right? That underpins every single thing we do at BlackRock. In fact, it has been there since our founding over 30 years ago. The essence of BlackRock is really being a risk manager first, right? Having that risk mindset first. And it's about taking risk in a deliberate, diversified, and appropriately scaled way. We actually say the worst risk you can take is the risk you're not aware of, right? So again, bringing more clarity and confidence and context to our clients is what we're trying to do. So I titled this talk, "The Great Moderation is Over." This sort of ties to our 2023 investment themes, which is sort of living this with this new reality of inflation. Everybody's felt that. in a lot of different ways. The Fed's balancing act, so I'll talk a little bit about that, as well as volatility as the new norm. So this story is sort of where we've been, where we're at, and where we're going. If I think about where we've been, like what does the great moderation mean, right? What are the implications of that? Well, quite simply, it's been 4 decades of largely stable activity and largely stable inflation. That's basically my lifetime. If I rewind even before those 4 decades, what was happening in the world, right? In the 1970s, there was actually a lot going on in the world, and it started with some massive macro changes like the OPEC oil embargo, if anybody remembers that, back in 1973 and 74, which created an unstoppable rise in inflation. Inflation in 1980 hit 13.5%. I'm sure some of you remember that here. And there were things like the WIN campaign. Does anybody know what WIN stands for from the Ford administration? Whip inflation now. Didn't work, but it was a great campaign at the time. The WIN campaign existed, right? There were pins out there associated with that. But it wasn't until Paul Volcker stepped into the Fed, being the Fed president, which he ran from 79 to 87, and having him push federal funds rates, which is the price of money, right, interest rates that commercial banks are loaning each other, to 20%, then inflationary pressures started to actually recede. Now, I talk to my parents a lot, and I've asked them, when you first bought your home in 1980, what was your mortgage rate? It was like 16%. 18%. Does anybody remember getting 3/4 over prime back in 1980, what that represented? That's a 22% interest rate at the bank. Can you imagine? Right? So nobody believed it at the time, but because of Paul Volcker's initial actions, that led to 40 years of declining interest rates, right? Nobody knew it at the time, but like, what are the consequences of that, right? It resulted in a rebirth of optimism. Obviously, there's a lot of uncertainty and risk aversion at that point. The pursuit of profit was back on, right, with new and innovative investments. You know, BlackRock has benefited from that with the invention of ETFs, as an example, exchange-traded funds. I know insurance products, alternatives really took hold. And over that 40-year time period, the S&P started in 1982, August 1982, at a low of 102. It reached an all-time high in January of last year of 4,796. It's at 3,800 today. That is a greater than 10% annualized return for 40 years. An incredible period, right? They call it the great moderation, right? Stable activity, stable inflation, right? So what did declining rates do for everybody in this room, right? My entire lifetime, what did it do? It made it cheaper to buy on credit. It provided a subsidy for borrowers. So this is I'm ashamed to say it. My parents' mortgage rate was 16%. Bought a home 2 years ago, sub 3% for 30 years fixed. And that's at the expense of lenders and savers, right? So people probably know it didn't feel great to hold cash in the bank the last couple of years. It reduced business costs of capital. Everybody knows that in this room, and increased profits. It increased the fair value of assets. Like the fundamental math behind stocks is it's the present value of future cash flows. When the denominator, the interest rate goes down, the value of stocks goes up, right? Just fundamental math. In bonds, it was incredible. When rates went down, prices went up. So as a portfolio owner, that created an incredible diversification and return potential when you held fixed income in your portfolios. And then last but not least, the wealth effect, right? Everybody felt good about what happened. Now, I'm not discounting the tech bubble. I'm not discounting the global financial crisis. I'm not discounting the COVID scenario. But I'd argue that the last two events in particular further propelled the incredible setup that we saw over the last 40 years, right? Because of all the money that was printed, and the way that the Fed acted, right? There was just so much liquidity out there. And Howard Marks, if anybody knows Howard Marks, writes a blog. He's a co-founder of Oak Tree Capital. Has a great imagery for this as you think about what was happening in the world. Does anybody, go on those moving walkways at airports, right? Does anybody just stand on them? No, most people walk on the moving walkway. That's essentially what was going on. Not only was the world moving, you were moving faster because at a double rate because of how low interest rates were. So that's where we've been. I just want to make sure you sort of understanding, there's so much else that went into that. That's kind of set up, put everything in perspective for the setup of what happened last year. And I love this. My colleague in iShares, Gargi, came up with a sort of a melodramatic phrase for last year. She called it the year of the slap, which quite literally, you had the big slap, Chris Rock back in March. And figuratively, you had the brutal market performance, consumer manufacturing sentiment, growth expectations, all getting slapped, right? Why? And everybody knows this. Inflation, inflation, inflation. We already have a question. Yes, ma'am. Yeah. Yes. It got exacerbated tremendously because the asset owners took all the beneficiary of those low rates, without question. Right. The wealth effect was felt by fewer and few, that's for sure. Yeah. So inflation last year, right? So let's just talk about 2022 for a second. The S&P hit an all-time high, I mentioned in January, literally like the beginning of the year at 4796. Did you know there were 70 such occurrences of all-time highs in 2021? It was a wild market, but it was just one all-time high after another in 2021. It hit its all-time high in January of 2022. And at the time, what was the word of the day from the Fed about inflation? Does anybody remember? I know there's some people in finance here. Transitory, which I didn't even know what that existed as a word, but that was the word of the day. This is just transitory because of the COVID restart. Everything will come back to normal. And boy, were they wrong. In fact, I'd argue that was their biggest mistake. And now they're trying to make up for it today. The Fed at the time was only expecting to raise the federal funds rate, again, the price of money, by 80 basis points. They ended up doing it by almost 400 last year, right? Talk about being wrong. Again, my colleague Gargi coined a phrase and a quote that's famous out there from Lenin during the Russian Revolution. Lenin said, there are decades where nothing happens, and there are weeks where decades happen. That was 2022, right? There were weeks when decades happened. Surging inflation, war in Ukraine, commodity crisis, crypto collapsing. I don't know who bought some crypto here in this room. I'm not going to call anybody out, but man, that was a wild ride. And then obviously the Fed began its fastest rate hike since the 1980s. CPI in June last year hit 9.1%. God, I hope that's the highest level we'll see again in our lifetimes, but who knows? GDP was forecasted to grow year over year at 4% to start 2022. Now the Fed's forecast for 2023 is year over year growth of basically nothing. So how the world has changed. The worst 60-40 performance on record for a portfolio. The S&P was down 20, NASDAQ down 32. Core bonds, which everybody thought were safe, were down 13%, right? So there was no place to hide unless you had cash. You weren't getting any interest on it, you had cash, or you were prescient enough to buy commodities and real assets, which did very well last year. But mostly everything sold off, which made it really hard as a portfolio consultant to explain where to find defense last year in the markets. So knowing the Fed is now finally acknowledging their initial mistake of just staying low for too long, it is very clear at BlackRock to us that the Fed is now pushing higher for longer, right? And so we'll talk a little bit about what that means, but the behaviors of all the players have changed, right? So the Fed has gone from highly stimulative to tightening. The economic outlook has gone from positive to recession likely. Buyers have gone from eager to hesitant. Key worry last year was FOMO. Man, if I don't buy that Dogecoin crypto, I'm gonna lose out. Now it's investment losses. Risk aversion was absent to now rising. Financing, as you all know in this room, was plentiful. Now it's scarce. Interest rates, lowest ever, we'd argue more normal levels. And prospective returns, meaning forecasted returns, were lowest ever, given the run of the markets. And now we'd say they're actually at a more ample level. So go back to that airport walkway, and I'd argue that, it's essentially paused. And if not, the Fed is trying to engineer a reversing of that airport walkway, given all the growth that was pulled forward the last couple of years. So I'm not trying to paint a terrible picture here, but I'm just trying to give you the reality of what we see at the end of the day. So new investment playbook looking forward, right? Living with inflation, the balancing act of the Fed, and volatility as the new norm. I've already said it. Central banks view inflation as the number one thing to get right now. And so they are, we'd argue, deliberately trying to over-tighten to compensate for being overly loose with possible recession consequences. Now, we don't think it's going to be a deep recession. Shallow recession with a recovery, but they're trying to engineer that to make up for their past mistakes. We see headline inflation, which is around 8.5% right now, getting to about 3% over the back half of this year, right? So that's getting in the right direction. Their long-term mandate is 2%, so it's still going to be persistently high. Aging population, supply chain issues. My dad works for Elliott Lewis, based out of Philadelphia. It's a commercial outfit. They do, a mechanical work, AC work. He was telling me the other day that when he tries to order a rooftop AC unit from Carrier, it used to take 8 to 12 weeks for that unit to be delivered, to put on the roof. Now when he talks to the rep at Carrier, he basically says he doesn't know, and it's more or less showing up in 30 weeks. And a supplier like Carrier has already risen their prices 4 times last year. So imagine being the buyer of that, the owner of that building where you're trying to get a new AC unit. You have no visibility into what the pricing of that unit will be at this point in time because of the supply chain issues. So that's the first thing, living with higher inflation, and we could talk a lot more about that. The Fed's Balancing Act, I've talked about it a little bit already. When they lower rates or when they move rates, they can't influence production constraints in supply chains, right? It's just fundamentally, that's not what the interest rate does. What it does influence is the demand side, and you guys know that, right? So they're essentially stuck between a rock and a hard place right now. Either get inflation back to 2% by bringing demand down to what the economy can comfortably produce, or live with more inflation. We think they're trying the first option right now, but we ultimately think they're going to have to live with the second, which is just living with higher inflation. And so that's the setup that we have going into next year. Again, I mentioned shallow recession. We think the Fed, as it views this year and the progress of inflation sequentially falling, that's what matters, sequentially, not year over year, because you're going to have some base effects here where it's going to get a little funky. But as they see inflation sequentially falling, they'll eventually pause their rate hiking cycle. Right now, the Fed funds rate, again, the price of money is around 4.5. We see it, we're still kind of climbing that mountain. We see it getting to between 5 and 5.25. So you're likely to see a couple more rate hikes, not as extreme as we saw last year, but that's what they're trying to do, right? They're trying to get demand down to a more comfortable level, and they're going to ultimately have to live with higher inflation. So all of this is driving a new investment playbook. Alas, you can essentially jump off that walkway and walk at your own pace with a couple of these ideas. It's important to note that what worked previously is, we think, is going to struggle mightily going forward. Those are things like buy the dip, right? There was that mentality that there was the Fed put out there, buy the dip, like that worked. The mean reversion mindset, just holding beta. Some of my colleagues would just call it stupid beta. You were just buying the market and voila, you got your returns that you needed. And holding duration in bonds, right? Those were things that a lot of people were doing over the last couple of years. So we think you need to have a more careful thought to this. And for the first time ever, BlackRock is actually not putting forward investment views for the entirety of the year. So we've now, if you go to our website, we've kind of have short-term views and more longer-term over sort of full market cycle views. But we're setting ourselves up to realize that there's going to be a lot of uncertainty to begin this year. And so we're actually in our most defensive positioning right now. But we're also telling investors, be prepared to be nimble and to shift that as the Fed changes what they're going to do. So a couple things. Again, I'm not trying to be the bearer of bad news, but we still think not all the damage has been done in equities, right? Equities have obviously fallen quite hard, but there's still more damage to be had there. The bright side of all of this, and I mentioned this to a couple people before, is that higher yields are a gift to investors, especially retirees and savers. My parents are now set up to get at least 4.5%, 5% in relatively less risky investments as a steady stream of income. They never had that potential over the last couple of years. So I think in a weird way, higher yields is a perfect setup for retirees and savers at this point. Let me just talk about asset classes, and then I'll pause and see if you guys have questions. Equities. We don't think you should sell equities, right? Actually, strategically, when we say strategic, 10 plus years, we still think equities are going to outperform bonds because of where valuations are. But near term, we favor defensives like healthcare, dividend-paying stocks, and beneficiaries of higher inflation like energy and infrastructure. Speculative growth stocks will continue to struggle mightily. Higher rates are just going to continue to pinch those types of companies. Credit bonds. This is our biggest conviction overweight right now. As I mentioned, yields are greater than 4%, well higher than the 1% average over the last 20 years. So we've been saying bonds are back, and you don't have to go far out the curve. When I talk about the curve, right, you can buy 2-year, 3-year, 4-year, 5, 10, etc. You could get within 3 years 4.5%. And not take a lot of term premium. That is a very attractive investment for us. And we think people are starting from a pretty good credit position. So we're max overweight investment grade credit. And we think there's a lot of great income potential there. We still like up in quality, so we're kind of neutral high yield. But at the end of the day, investment grade credit, kind of on the shorter end, that's the sweet spot we're seeing right now. In terms of treasuries, right, issued by our government, there's a lot of dispersion here for us. We're kind of max underweight the longer term part of the curve because, again, with higher rates, that's where you don't want to take a lot of interest rate risk. We're max overweight inflation-linked bonds. So I don't know if you've owned inflation-linked bonds before, but we think with persistently high inflation, that's a great instrument to have in client portfolios, in your portfolios going forward. So we really like inflation-linked bonds, and we actually like them in almost any scenario at this point. Munis, I know there are muni holders here, there are muni buyers, very constructive view. We think the states and local governments have been very prudent with their budgeting and are well positioned to absorb any type of recession. So we like the tax equivalent yields there. Internationally, we're underweight Europe. Stagflation is real over there, and a lot of that is because of the war in Ukraine. 40+% of their energy sources were coming from Russia. So we see inflation north of 5% for Europe, and we see the whole supply chain getting rewired over there. So you get just Europe. We're not saying sell, but we're definitely underweight. China, we're neutral. Really hard to say exactly what's going on there. They've obviously had a really intense COVID shutdown that they're now trying to reverse. At the end of the day, we just see tighter state controls making assets in general riskier in China. So we're neutral on China and the emerging markets more broadly speaking, but there's more risk there than anywhere else internationally. I'll just summarize. I love the Yogi Berra quote, "The future ain't what it used to be." That's so true right now. The future ain't what it used to be. It's about pricing the damage, rethinking bonds, as I've talked about. It's living with higher inflation. The aging workforce is a big part of that. The rewired supply chain, a big part of that. We're saying be more nimble, be more patient, have a more nuanced approach versus just trying to buy broad markets, right? So we're giving some granular views if you're interested in sort of the more finer details. I do like to sort of end with a bit of an anecdote, right? So I don't know if you know Morgan Housel. Morgan Housel is a behavioral psychologist, behavioral finance guru, and he posts a great blog. And there's a blog out there that's called Getting Wealthy versus Staying Wealthy. And I think it's perfect for this type of environment as we talk about being more patient. And essentially, the headline is good investing is about not necessarily making good decisions all the time. It's about consistently not screwing up, right? And it's really easy to screw up right now. It's super easy, right? You can go out and try to buy that speculative growth stock that's been down 60% and try to capture the upside versus buying that 4.5% short-dated credit bond and just being patient, right? And Morgan says in this blog, and I encourage you to go read it, like there are a million ways to get wealthy, but there's really only one way to stay wealthy, and that's a combination of frugality and paranoia, right? And I think we've got a lot of bit of that in this room, right? Coming forward, like being frugal and being paranoid. There's a reason why, if you look at the Forbes annual richest Americans list, every decade that list turns over about 20%, right? Right? People can get rich, but it's hard to really stay there. And in fact, there's two different skill sets associated with that. And the story I like to tell is the story of Warren Buffett and Charlie Munger. Everybody knows who they are. Charlie, I think, just turned 99. Incredible success story of patience. But did you know there was a third partner when they first started? Does anybody know that? There's a guy named Rick Guerin who was part of the triumvirate of Berkshire when Charlie and Warren started, when Charlie Munger and Warren started investing. And nobody knows about him, right? And Warren was asked about this, and Morgan talks about this. And Warren's response was, well, it's quite simple. We were not in a hurry to get wealthy, and Rick was. And what ended up happening was, in 73 and 74, when the downturn happened, Rick was forced to sell his Berkshire stock back to Warren for less than $40 a share because he had margin loans. He basically was just trying to take the stock and supercharge it because he wanted to get rich fast. And the rest is history, right? So I think it's a powerful lesson in just be patient at this point, right? We experienced some outsized returns. We've all experienced it. We're hitting some choppy waters. You got to be patient, got to be nimble, got to study the markets, flex that curiosity muscle a little bit more, figure out what's going on. And, you know, I think you can be healthy and wealthy in the long term when you do that. So with that, let me pause and see if there's any questions. Hopefully that was helpful. Yes, sir.
Any further expansion on 529?
Specifically related to
Right, college funds, just because they're very stagnant, many things.
in terms of legislation and ruling about.
In terms of growth,
Well, it's a combination of two factors there, right? More people contributing to them, right? Which I've been since my kids have been born, and the growth of the markets, right? So I think it's a sort of an education of, as you know, as you're early on in life, explaining when you're building a family how important this tax shelter can be. So more education on that. We have a whole 529 plan and program at BlackRock that talks about the power of that. But I think it's just about education. So I'm not sure if I'm answering your question, but the expansion of that, to me, is about getting more people to understand it first and foremost, the benefits of it. That's where it starts. And I think we need to do a lot more on that, just like Social Security, by the way. We have a Social Security program. It's the number one program that we have for clients right now. And then we have a 529 program, just really talking about the education of that and the benefits. And, you know, it really changed for me a couple years ago when they went from saying it's just for college to now you can do it for secondary schools and private schools. So now the flexibility is even more than what it's ever been.
yeah, it was an incredible vehicle, and it was very, I think, conservative in its exposure, but it just seems like it has much more market exposure now because of how it's tanking.
Well, I mean, yeah, everything's tanking. So my guidance would be look at your asset allocation, right? The big thing to get the big things right. If your asset allocation is 80% stocks, 20% bonds, maybe it should be more like 70-30 or 60-40, especially with the fixed income part now giving income. You got to be more patient, but I would look at the asset allocation. because that's what's hammered most of them. They're mostly aggressively positioned with more stock, way more stock than bond.
That's true. Okay.
So, go ahead.
I'm curious about something that maybe you can address or maybe you can't. But BlackRock has this huge building on Alexander Road in West Windsor. And ever since COVID-19, or when everything has changed in the country and in the world, I suspect that that building has been less than 100% occupied. Is it being occupied today? What percentage of employees are there? And is there a future plan with regard to that building in light of the changed world that we live in?
It's a great question, and maybe I won't answer it just about Alexander Road, because I think it applies to all of our office buildings. And quite honestly, a lot of the financial competitors that we go to business with, like, they're all doing the same thing. To answer your question directly, yes, the building is occupied. We've got about 1,000 BlackRock employees that are based out of Princeton, New Jersey, on Alexander Road. Our firm guidance has been, you have to be in the office at least 3 days a week. So we've been trying to adopt a hybrid schedule, like many of our financial competitors. So this is no different, right? I think you saw headlines this week, Vanguard putting ultimatums out there. If you're not in the office 3 days a week, you're not going to be employed anymore. We haven't gone that far yet at BlackRock, but you're starting to see that snowball effect take hold. I know, for example, in Philly, Comcast asked everybody to do the same thing in Center City, Philly, and so you're starting to see a lot more foot traffic. So I don't think the footprint of the building for us is going to shrink per se, because we're still asking people to come in 3 days a week. But on Mondays and Fridays, you might see a pretty sparse parking lot because more people can work from home. And I quite honestly like that flexibility. But as a manager of a team, I need people back. I need people back to train them, to build the right kind of culture, to just build the right camaraderie, to allow them to kind of, showcase what they can do. It's hard to get promoted when you're just sitting in your pajamas at home, right? Like, and these young people, they feel like they should get promoted. So you got to get back to the office, and you're going to see more of that going forward, in my view.
What is the feeling as far as efficiency of BlackRock and others in your industry during this period of time where people have been at home, maybe coming into the office occasionally?
Yeah.
But has efficiency changed? Has it increased, decreased? Is there any study of that BlackRock has made?
I haven't seen a study of it. I know initially during the pandemic, everybody was talking about productivity going way up. I think there's little truth to that. But, I mean, I know for myself, it was hard to disconnect between work and the home life when my work is right on the other side of that wall. So I was working really long hours. But I mean, I think there's a balance, right? If you're working on a big project and everybody needs, to kind of lean in, it's hard to do it virtually. It's hard to be as inclusive when somebody's sitting virtual when you have a room of people in a group meeting. So I haven't seen a study on efficiency yet. I can tell you what swamped the industry is the higher rates and the inflation last year. 2021 was an industry-shattering year for us in terms of flows. 2022, not so good. This year, big question mark right now. And you're starting to see like business owners react to that, right? Lower bonus pools. Goldman has the headline out there that they're going to lay off thousands of people. You saw Salesforce shrink their employee base. So I think, nobody's immune to this. I think people overhired during the pandemic, and now they're realizing, okay, demand is down. The Fed is actually being successful with this. Therefore, we don't need as many people, and you're going to find an equilibrium this year. But I'll have to dig into the efficiency side of that. All right? I think I've overstayed my welcome. Thank you.
I want to thank Your Town Tube, who is doing the video, does it religiously for us for a number of years. Over 26,000 videos that they have out there. And Mercer Local Influencers, the new show, is phenomenal. And the Buy Local Connection, if your company has not got a video on there, get your video on there. If you're a sponsor and your name's up here, it's free. You can change it every week, 1 to 3 minutes, I think it is, that you can either do it on your phone or they'll help you do it. And those videos are really, really reviewed. And Mercer Local Influencers and those shows are phenomenal.